Hello, this is Mijin from Meekju University. Let's start Meekju City News for October 29th. Welcome to Mijon, where we remain committed to the fundamentals of United States stock investing. Today, I will start by sharing an important announcement first. When I moved to Malaysia 3 months ago, I made a promise to myself. The first thing was to reduce my working hours. When I was doing research, I often worked more than 12 hours a day, so I started to feel my health getting worse. So after coming to Malaysia, I promised myself to work only about 8 hours a day like regular office workers. The second thing is, if something comes up related to my family, I decided to change my priorities and focus more on my family than on work. So tomorrow, there's an important event at my children's school. Even if I have to take a break from broadcasting, I definitely want to participate, so I do feel sorry for taking breaks from broadcasting so often. I hope you all can understand. That way, I think I can keep running the Mijun channel for another 5 or 10 years. I'm also running a paid membership, and recently, there were times when I could only send 2 or 3 pieces of content a day instead of the usual 7 or 8. So there were some people who complained about that. One thing I can tell you is that the Mijun paid membership is less about news and more about me analyzing a single article very thoroughly and deeply. It's shifting towards sharing my personal thoughts and insights. So even if I can't send it to you right away, whenever there's something important or significant news, I make sure to share it with you after a few days through in-depth analysis. That's why even though I was a bit delayed last week, I actually worked really hard over the weekend to upload everything. Usually I don't share much content on weekends, but if I miss something during the week, I do my best to share detailed articles and my insights with you even on weekends. I hope you keep that in mind. So after today's broadcast, I won't be able to greet you at all tomorrow. I'll be back to see you all again on October 30th. Alright, then let's get started with today's Big 2 news prepared for October 28th. Before I share today's prepared broadcast with you, there's an article that came up that I think is worth thinking about together. I'll start by covering this part first. Earlier today, there was news about Amazon. This news caused quite a stir. Let me explain what it's about in Korean. Amazon. Reuters just reported that Amazon is planning to cut up to 30,000 office jobs. If they suddenly cut 30,000 jobs, that's said to be about 10% of their total workforce. Amazon currently has just over 300,000 employees at its headquarters and plans to lay off up to 30,000 at once. Now, if we scroll down and take a closer look, according to a New York Times report, Amazon employees hired before 2033. They plan to strengthen robotic automation enough to replace 600,000 jobs, and by 2027, it is projected that about 160,000 more people will be laid off. So what the New York Times is saying is this: Amazon's robotics team is working to automate 75% of the company's entire operations in the future. They're saying that 75% of the entire operation will be replaced by artificial intelligence and robots. I felt a bit uneasy when I read this article. I mentioned this once before as well. I'm not afraid of a bubble forming around artificial intelligence. What concerns me is that artificial intelligence is evolving and advancing much faster than I expected. In the end, what worries me more is what if it takes away all of our jobs like this? Because if so many people keep losing their jobs like this, the unemployment rate will keep rising. And eventually, what we usually check, like the number of unemployment benefit claims, will also get much worse. If that happens, then no matter how much the artificial intelligence revolution accelerates, won't the United States economy and the global economy inevitably face a recession? Because the number of consumers will keep declining. So, I want to emphasize once again, that the rapid development of artificial intelligence actually feels even more frightening to me than the possibility of an artificial intelligence bubble. Yesterday, United States stocks were driven by artificial intelligence beneficiaries. As you can see, among the 500 companies in the S&P 500, the tech stocks are showing the brightest green color. Market breadth was strong yesterday. You can see there are a lot more green stocks than red ones, but if you look at the other stocks, the green is a bit dull. So the gains were limited. Instead, you can see that artificial intelligence beneficiaries and tech stocks, led by megatech companies, are showing very positive momentum. Let's take a look at the market breadth. Yesterday, the market breadth rose to 56.06. It was 52 only a day ago. So now 56% of stocks are in a good short-term trend, which means the trend is turning very positive. And 63% of stocks are in a good long-term trend, maintaining a healthy level. Next, let's review the Volatility Index, the Fear and Greed Index, and Choice Stocks Market Score. Before that, let me share a simple question with you. This is a comment left by Lee and Guyong. Choice stock is showing greed, but why is the Fear and Greed Index still staying at fear? That's the question that was left. I think I should give you an answer to this. First, if you go into choice stock and look at the market score, just like yesterday, it's at the greed stage. So, how should you interpret this? It means that there are a lot of stocks with a good current trend. Earlier, we looked at the breadth of the market, and this is a similar concept. It means that we're in the stage of excessive greed. Right now, when analyzing stocks, there are significantly more stocks receiving buy or hold recommendations compared to those that are receiving sell recommendations. Therefore, it can be interpreted that the current momentum is strong. On the other hand, the Fear and Greed Index, which we call the Fear and Greed Index, is still at 37. It rose slightly from yesterday, but remains in the fear stage. Now, with so many stocks showing good momentum, you might wonder why the market sentiment is still fearful. Now, the reason for that, which I explained before as well, the Fear and Greed Index is calculated by combining 7 different indicators. But right now, several indicators are all staying in the fear zone. I think it would be good to show you each one. If you look at Enterprise Brace, this involves analyzing rising stock prices and trading volumes to determine if increasing or decreasing stocks have higher volume, helping gauge market sentiment. Now, of course, at the current level, it's showing a neutral stance rather than extreme fear. But the reason it's still marked as extreme fear is because, for a while, the trading volume of rising stocks was overwhelmingly higher. Therefore, compared to a few weeks ago, the level has dropped significantly, so you can see that it's now down to extreme fear. The fortunate part is, price brace is currently on an upward trend, so you can see that the atmosphere is gradually turning positive. Now, the same goes for the put and call options below. A put option is a bet on a decline, and a call option is a bet on a rise. Now, as you can see, the call ratio has been on an upward trend for a while. That's what it is. This shows put options were gaining popularity faster than calls. That's what it means. That's why we were in a fear phase. The good news is, if you look at the absolute value, it's still not at a high level yet. And another thing is now it's turning and dropping again. That means the ratio of call options is gradually becoming higher than the ratio of put options. So it seems we can see here as well that the market sentiment is improving. Now, on the other hand, the volatility index is coming up. The volatility index has turned neutral, so if you just look at the volatility index, it seems there is no fear in the market. Now here we also have fear and something called safe haven demand. What this means is that safe haven refers to bonds. So it's about comparing the yields of bonds and stocks. This also showed a downward trend for a while, but then it started to rise again. We can expect that it might be upgraded back to neutral soon. Now, lastly, junk bond demand. I explained this before, but junk bonds are bonds issued by companies with very weak credit ratings. Therefore, if there are growing expectations that the United States economy will not do well in the future, junk bond yields suddenly rise sharply. That's the only way people will be willing to buy these junk bonds. Now, the current levels have been steadily rising, so as the yields on junk bonds go up, There was a growing fear that the economy might slow down. But the good news is this too has peaked and is now declining again. So the overall trend is gradually stabilizing now. I think we can interpret this positively. Now, next we'll look at the volatility index. The volatility index, it keeps dropping, and now it's at 15.79. Now, the fact that the volatility index has dropped to 15 means that things are unusually calm. I actually think 15 might be more unsettling than 16, 17, or 18. What I mean is, even just looking at this week, there are a lot of major catalysts that could cause significant volatility. Megatech companies are announcing their earnings one after another. On top of that, the Fed is scheduled to announce its monetary policy after the Federal Open Market Committee meeting. So, what does it mean that the volatility index is below 16 despite everything? Most investors believe that these catalysts will drive stock prices upward, not downward, and that's why they have such a positive outlook. So, when so many people are only thinking in a positive direction like this, if an unexpectedly negative catalyst is found, the stock price could be shaken. That's how it could be interpreted negatively. Let's review Midyaone's top pick performance. Yesterday, artificial intelligence beneficiary stocks and tech stocks performed really well, so Midyaone's top picks were generally on an upward trend. Plus, cryptocurrencies were also doing really well. Alright, first ETHT. Recently, the ProShares Ultra Ether Exchange Traded Fund, previously the slowest, surged 13.51%. Second, B2 rose 7.69%, while Bitmine climbed 6.55%. Tesla gained 4.31%, Alphabet 3.60%, and Nvidia 2.81%. Advanced Micro Devices finished up 2.67%, CoreWeave up 2.65%, First Solar up 2.60%, Palantir up 2.46%, Strategy up 2.27%, Broadcom up 2.24%, Coinbase up 1.97%, Celestica up 1.75%, Meta up 1.69%, and Taiwan Semiconductor closed up 1.12%. Now, on the other hand, if you look at the stocks that showed a decline, Bitcoin and Ethereum have turned to a slight downward trend. Tail Energy dropped 0.5%, Credo slipped 0.17% and 0.38%, and Vistra fell 1.08%. These three stocks have seen a significant increase in their prices recently, so we can say that they underwent a technical correction. The first news I want to share with you today is about earnings results. This week, the earnings results of our favorite tech stocks are being released one after another. The first one up was Celestica. Celestica, one of our top picks in the United States, announced its earnings after the United States market closed yesterday. Fortunately, after the earnings announcement, the stock price is soaring by 10%. Now let's take a closer look at what kind of earnings were announced that caused such a sharp rise. Let's review the main highlights of Celestica's Q3 earnings. Celestica posted an earnings surprise in the third quarter of 2025, significantly exceeding Wall Street's expectations. You can see that explosive demand for artificial intelligence data center infrastructure drove their performance. Accordingly, the company raised its guidance for the fourth quarter, the full year of 2025, and even for the full year of 2026, which is very positive. Now, as you can see here, I've organized the revenue, earnings per share, and operating margin into a table. So let's take a look at each one. First of all, the revenue was $3.19 billion, whereas last year it was $2.5 billion. So compared to last year, it recorded a growth rate of 28%. The second is non-generally accepted accounting principles earnings per share. Growth stocks often use non-generally accepted accounting principles. The official figures are generally accepted accounting principles, but you might ask, why do they use non-generally accepted accounting principles? But when there are a lot of one-time expenses, it might actually be more important to calculate by excluding these one-time expenses. The non-generally accepted accounting principles earnings per share was $1.58 up from $1.04 last year. So you can see that net profit has surged by 52%. Now, if you look at the generally accepted accounting principles below, the growth rate is 200%. This means there must have been some one-time expenses last year. So the actual net profit growth rate of 52% is actually more accurate. Next is the operating profit margin. The operating profit margin was reported at 7.6%, which is an additional increase of 0.8% compared to 6.8% in the same period last year. Therefore, the margin is also improving. If you look at the gap, there's a big difference. Last year it was 5%, and this year it's 10.2%, so there's quite a difference. This is because of last year's one-time expenses, so it's more accurate to use non-generally accepted accounting principles figures instead of generally accepted accounting principles figures. I think that's the right approach. Next, let's review performance by business segment. Celestica has two important business segments. The first one is called Connectivity Cloud Solution, which stands for Connectivity Cloud Solution. This segment is crucial since Connectivity Cloud Solution links to artificial intelligence. Revenue from this segment rose 43% over last year. Now, even if you look at the absolute value, it's $2.41 billion, which is much higher than the average ticket size below. It's increasingly important. So, why did this segment's performance surge 43%? It's artificial intelligence, of course. Now, as shown here, hyperscalers, meaning the large cloud companies we know, are investing in artificial intelligence data center networking switch programs. We're talking about companies like Microsoft, Amazon, Meta, and Google. As the demand from these customers continues to accelerate, it can be interpreted that sales have increased explosively. In particular, the sales of the hardware platform solution led the growth, reaching about $1.4 billion, which is a whopping $479 million or 79% increase compared to the previous year. You can look at it this way. So if you look at these results, Celestica is expanding beyond basic electronic manufacturing services. It is establishing itself as one of the key pillars in the artificial intelligence data center infrastructure supply chain. So until then, it was just a supplier that made and delivered what megatech companies wanted, but now you can't see it that way anymore. We can interpret it as playing an important role in the artificial intelligence revolution and becoming an indispensable and extremely important company. Next is average ticket size, short for Advanced Technology Solutions. First of all, sales actually decreased by 4% compared to last year. Now, here's a really interesting part. The profit margin for this segment actually improved. Usually when we run a company and sales decrease, we often end up lowering prices. And by doing that, we try to stimulate demand and do whatever we can to boost sales again. But what about Celestica right now? Their margin increased despite lower sales. What does it mean when margin rises as sales drop? They're probably focusing more on high value added business. Currently, the company is focusing all its capabilities and workforce on hardware, platforms, and solutions. So they're somewhat ignoring these advanced technology solutions that don't make much money, and the company is now focusing more on artificial intelligence. You can interpret this positively. Now, next is the guidance. This time the outlook and guidance for the future have all been revised upward. Celestica significantly raised its future guidance based on strong third quarter results and continued strong demand. That's how you can summarize it. Now first, let's look at the outlook for the fourth quarter. Expected next quarter revenue is $3.33, $3.58 billion above the market's $3.1 billion estimate. So they've reported that they could far exceed the market's expectations. Now, if you look at the expected adjusted earnings per share, it's between $1.65 and $1.81, while the market expectation is only $1.52. So they're basically forecasting that the performance will be outstanding in the fourth quarter and the next quarter as well. Next, let's review the full fiscal year 2025. The projected revenue is now $12.2 billion, up from 3 months ago. They claim they could make $11.55 billion. So in just 3 months, the forecast for future revenue has been sharply revised upward. This part is very positive. The adjusted expected earnings per share actually increased from $5.50 to $5.90. Next is the 2026 annual outlook. Things look really good up to this year, but whether this positive trend can continue into next year is a very important point. Let's review the sales. Expected sales are $16 billion. This year, they raised their guidance to $12.2 billion, but even so, they're saying that next year they can grow an additional 31% compared to $12.2 billion. What about the expected adjusted earnings per share? They said they can reach $8.20. This year, it went up to 5.90. So compared to 5.90, next year's net profit has increased by almost 40%. October stock price? The stock price guidance was previously on this side, HCOM. Sometag years. We usually use a peg of 1.0 as the standard. So you can think of it as the growth rate, and the pair should be at similar levels for it to be appropriate. Now, so what if the earnings growth rate can reach 40%? Then you could say that Celestica deserves a PR of around 40, right? So next year's earnings could be $8.20, and we can set the PR multiple at around 40. If that's the case, even if it reaches around $328, it would be hard to say that Celestica is overvalued. That's how we can sum it up. What about Celestica in reality? It has gone up to $332 in after-hours trading. So if it rises to $332, you could say that it has now reached its fair value. Now, not only did they have good earnings yesterday, but there was also some very welcome news. They announced a shareholder return policy. Celestica announced that it plans to start a new share buyback program. This program is expected to begin in the fourth quarter of 2025, that is, within a few months. Through this, they stated that they can buy back up to 5% of the publicly traded shares. Let me quickly explain what it means to repurchase up to 5% of their own shares. If you reduce the number of shares in the cell, the earnings per share eventually increases. Because in this example, let's assume the net profit is 1,000, but originally there were 100 shares, and earlier we said the company buys back 5% of its own shares, so the number of shares, which was 100, decreases to 95. Earnings per share is calculated as net profit divided by the number of shares. Earnings per share stands for earnings per share. Now, when we divided 1,000 by 100, the net profit per share was $10. But if the number of shares decreases by 5%, the earnings per share rises to about 10.53, which is an increase of about 5.26%. So what does that mean? If the earnings per share can rise by more than 5%, then the stock price can also increase by an additional 5% just through this share buyback. I think that's how we can calculate it. All right, here's the conclusion. How were Celestica's third quarter results? It clearly shows how strongly the artificial intelligence revolution is driving demand for data center infrastructure. Now, about that, not only Celestica, but as a result of Celestica's earnings, the artificial intelligence beneficiary stocks we are targeting have all turned positive across the board. That's how you should see it. Now, what about the overwhelming growth in the connectivity cloud solution sector? We can sum it up by saying that Celestica holds a key position in the artificial intelligence related networking hardware supply chain. The chief executive officer is Rob Mionis. Now, this is what he says. He says that they had a very strong third quarter performance and that the demand environment continues to strengthen. In other words, there are still many companies that want their products. Especially thanks to the demand for artificial intelligence data center infrastructure, they presented a strong growth outlook through 2026. The stock price has already risen significantly because the growth rate has been so good. But the chief executive officer summarized by saying that our growth trend will continue in the future as well. Since there will be no Mijun broadcast tomorrow, I'll read one more article today. I wrote an Nvidia article for the first time in a while. Yesterday, Nvidia's stock price surged by 2.81%, and whether you realize it or not, Nvidia's stock performance has been really strong. In just 6 months, it has soared by as much as 76%. Momentum has picked up again recently. Yesterday, we found a very positive piece of news worth our attention. Nvidia, you mean? It's good news that they're planning a German data center worth 1 billion euros with Deutsche Telekom in Germany. Let's examine the details. Nvidia and Deutsche Telekom are planning to build a data center in Germany worth 1 billion euros as part of their efforts to expand infrastructure across Europe to power artificial intelligence systems. The two companies plan to jointly fund this $1.2 billion project. According to sources, Europe's largest software company, SAP, is expected to be a customer of this facility. What about European policymakers and tech executives? They have been discussing for months the need for Europe to develop its own artificial intelligence ecosystem and catch up with competitors from the United States and China. But in fact, the discussion has only started recently. For such a long time, they didn't budge on artificial intelligence at all. The artificial intelligence revolution began at the end of 2022. Honestly, the European Union has done almost nothing so far. I once shared a video of Palantir's chief executive officer, and what he kept saying was that compared to the United States, the European Union isn't taking action at all. He said he's worried because the era of artificial intelligence has arrived, but the European Union isn't budging at all. He talked about this a lot. In fact, so far, only in the United States, tech companies including Microsoft, Google, and Amazon have invested hundreds of billions of dollars to build artificial intelligence computing capacity. You can see that the same movement isn't happening in other regions. What about Nvidia Chief Executive Officer Jensen Huang and others? They've criticized Europe for being too slow in developing its own infrastructure and supporting companies that want to use artificial intelligence while keeping data within the region. Now, what Europe is worried about is that American companies will come in and monopolize all this data. That's why they're not very favorable toward companies like Amazon, Microsoft, and Google coming in and building data centers. But now you can see that they've finally started to take action. As this news broke, Deutsche Telekom's American Depositary Receipt, or American Depositary Receipt, surged by 2% at one point during the session, hitting an intraday high. Even the €1 billion data center contract between Nvidia and Deutsche Telekom is actually quite small compared to the gigawatt-scale projects being announced globally today. The German project is expected to use about 10,000 GPUs. But as we know, there is a single data center led by SoftBank, OpenAI, and Oracle. It's being developed in Texas with an incredible 500,000 GPUs going in. So the difference in scale is just incredible. The European Union made this announcement last February. With the goal of tripling artificial intelligence system operating capacity within the next 5 to 7 years, they're aiming to support artificial intelligence development in this region. They announced a plan worth €200 billion. However, this process is progressing far too slowly, because the European Union still hasn't clearly presented how to review bids or allocate funds. If the plan is for the next 5 to 7 years, we need to act fast, but nothing is happening. It seems we're falling far behind the United States or China. After seeing this news, I had two thoughts. First of all, the European Union, which had been passive in building artificial intelligence infrastructure, is finally joining the artificial intelligence boom led by the United States and China. What that means is, in the end, another big boom could come for American artificial intelligence companies like Nvidia. That's because the European Union could spend a lot of money in the next 5 to 7 years. So, we can sum it up by saying that a very big positive factor has emerged. I think this means more than just having one more market. The reason is the driving force behind this wave isn't companies, but sovereign artificial intelligence, also known as sovereign artificial intelligence. What this means is that European countries will take the lead. Europe doesn't want to entrust its sensitive data to American big tech companies. So even if it means sacrificing some economic benefits and efficiency, they are faced with a geopolitical necessity to build their own artificial intelligence infrastructure no matter what. That's how you should see it. So they can't just tell Amazon, Microsoft, or Google to come in, quickly build data centers, and provide services to them. Therefore, they must build their own infrastructure. Even with these efforts to distance from the United States, Nvidia remains the main beneficiary. Back in 2020, I made a YouTube video. Let me show you a clip from that video. The fourth industrial revolution hasn't even started yet. And I once said that, in the end, the beginning of it will ultimately be led by American megatech companies. Now, if you look at the next slide, and behind those American megatech companies, there's Nvidia, who is sitting there selling GPUs. I've mentioned this before. That's what's happening now. There's already an artificial intelligence boom happening in the United States, and in the end, the megatech companies are working hard. They're building infrastructure by running data centers, and behind that, there's Nvidia selling GPUs. Nvidia's stock price has seen rapid growth over the past 2 or 3 years. Now, this baton is being passed to the European Union. The problem is the European Union is reluctant about America's mega tech companies. But even so, Nvidia can still maintain its growth by selling GPUs to European companies as well. Therefore, this proves why Nvidia is considered the biggest beneficiary of artificial intelligence, and that's how we can look at it. Of course, every country would want to avoid the risk of relying on a single supplier like Nvidia. That's why we also invest in stocks like Advanced Micro Devices and Broadcom. These secondary suppliers also have a big opportunity opening up for them. Now, secondly, through this article, I was once again reminded that the European Union's plan is too weak. Now, what did the article say? They set a goal to triple the artificial intelligence system capacity over the next 5 to 7 years, not by 30 times, but by 3 times. So, as I mentioned earlier, in Texas, 500,000 GPUs are being used in a single project. The scale just isn't enough in comparison. Now, they're investing 50 times more than the German project into a single Texas data center. But as mentioned in the article, even this is progressing slowly due to bureaucratic procedures. So, in the productivity revolution led by artificial intelligence, what is a productivity revolution? It's about amplification. Artificial intelligence is what turns a 10 into 100 and a 5 into 50. Therefore, in my opinion, it seems virtually impossible for Europe to catch up with the United States in the future. Now, I think this difference in speed, I believe this difference will significantly widen the economic gap between the United States and the European Union over the next decade. Now, this structure will eventually affect the flow of global capital as well. Investment capital always tends to flock to the regions with the fastest and most certain growth. Artificial intelligence isn't just a technology, it's an infrastructure that will underpin future industrial competitiveness. Therefore, considering this point, if the United States continues to maintain an overwhelming advantage in artificial intelligence infrastructure, it is only natural that global capital will become more concentrated in American companies. This is a reasonable assumption. Currently, there appears to be no alternative to United States stocks for investment. I think investing mostly in United States artificial intelligence beneficiary stocks is not only the most certain and probable bet for achieving abundant financial freedom, but also, in this turbulent era where the artificial intelligence revolution is in full swing, things are very uncertain. I would like to say that this is the most reliable insurance to hedge against this uncertain future. Now, let's take a look at Nvidia's momentum for the first time in a while. The momentum is amazing. Out of 26 indicators, there are currently no sell signals. 10 are neutral and 16 are pointing to buy. In addition, since the relative strength index is currently at 61, there's still plenty of room for further growth. That's how you should see it. Let's examine the stock chart and predict what's next. As it breaks out of the box range, the upward trend is strengthening. Now it has been moving sideways for about 3.5 months. That means it has accumulated a lot of energy over a long period. And when this kind of energy builds up and the price breaks out of the box range either upward or downward, it often rises or falls very sharply. Now in this case, there was a large trading volume as well. With this high trading volume, the price broke out of the box range upward, which is very positive. So, what does it mean when a box range is broken with such heavy trading volume? It might not be just a technical rebound. It could also mean institutional investors or large funds are buying. So it's likely that this upward trend will continue for a long time. We can have that level of expectation. Of course, there are risks. If this breakout fails and it falls back down to the upper end of the $185 to $215 range, we usually call that a fake out, a false breakout. Now, if it drops below 185 again, then there's a possibility that the trend could reverse. But for now, if the $185 level remains a strong support, then it's likely that the upward trend will continue for a while. The last content prepared for today is today's United States stock video. A technical expert appears in today's United States stock video. He is an expert who presents the outlook for the United States stock market through charts, and the current trend in the United States stock market is really impressive. It's at 6,877, and if it rises about 2% more, it could soon break 7,000. So, from a technical expert's perspective, will it just keep running up to 7,000, or will it take a break for a while? Let's take a look at the opinion of the technical expert who works with Mark Newton. Understood. That's all for today's stock news on October 28th. I hope today's broadcast was helpful for your investment activities. If you found it even a little helpful, please give us a valuable like. Also, feel free to ask questions, leave comments, and share lots of feedback in the comments section. Let's all keep going together until the day we can retire through investing in United States stocks. Have a happy day, and thank you.
The important thing is that China and the United States are showing signs of sitting down together to ease the recent trade tensions. I think this is a very positive sign that shows progress. For a technical analyst, the main concern is the market's current chart position. And we're paying attention to whether the possibility of a future Fed rate cut and the earnings announcements of mega cap tech stocks could change this trend. Expectations for a rate cut are already mostly priced into the market. As of now, there's a high possibility of 2 rate cuts by the end of the year, and the outlook that there could be 2 more cuts by fall is virtually set in the federal funds futures. I believe the reason the market is rising now is because optimism about this week's corporate earnings is growing. Especially among them, Maxil Jung Hauk's company is scheduled to announce its earnings this week, so it's a very important time. Additionally, with meetings by the Bank of Canada, European Central Bank, Bank of Japan, and Federal Reserve all happening consecutively, this is the most important week. The technical trend is also being strongly supported. However, it's important to note that most of the gains this time have come from tech stocks. Financial stocks and other sectors have lagged in the past month, and improvement here is key for a broader market rally. Financial stocks are the market's second largest sector. It's important for the rally to span all sectors, not just be tech-driven as it is now. If you check the equal-weighted S&P index, it's been flat for nearly 3 months. In this situation, a broad-based uptrend emerging in earnest is important for the next stage of the market. So far, there has been virtually no optimism in the market. The environment, once dominated by fear, has reluctantly shifted to an optimistic mood. Many investors are realizing that the market is breaking out, and they feel pressured to catch up with the S&P's movement to meet their year-end target returns. If this sentiment turns into aggressive buying in the next few months, that could actually be the time when we really need to be cautious. On the other hand, since market sentiment is still relatively calm right now, this point can be seen as the early phase of a transition. Momentum and market breadth are still okay for now, but there are signs of slight slowing. In my opinion, there's a high chance that volatility will increase in November. A steady upward trend likely won't last all year. The upper target is about 6,950, and we're nearly there. We'll likely reach it next week. A short adjustment period will likely be needed before further gains later this year. There's a high chance we'll see about a 3 to 5% correction in November. That's well within the expected range. The market rose 15% this year, 20% last year, and had strong gains the year before. That's why, even if people don't fully understand the clear reasons, it's very natural for these periods of consolidation to appear. What will be the direct trigger for the correction is a more complicated issue, but in my opinion, tech stocks are already overheated. Weak earnings from major companies like Google could cause a short-term correction for the Magnificent Seven. In such times, it's crucial to check if other sectors can support the market. That's because the market can only stay balanced if groups other than tech stocks participate.
If there's about a 5% correction in January, would that be a buying opportunity?
Yes, I see this as a clear buying opportunity. There's no sign the long-term trend is weakening. As I mentioned, most investors are still staying on the sidelines, so there are no signs that the market has reached a major peak. Corporate earnings are strong, but the labor market shows some weakness. But the overall fundamentals of the economy are solid. Therefore, what investors should focus on is that the market is technically in great shape, and this is supported by strong earnings and a stable economy. In fact, exogenous factors like geopolitical tensions or political events often do not have a significant impact on the market. In fact, even when you look at the issue of tariffs, their impact is gradually diminishing, and at this point, the effect on the broader stock market or the economy is minimal. What I consider most important is the financial sector. I believe the key is that this sector will start to move in earnest again in the fourth quarter. There were concerns about regional banks' credit issues, but it was more of an isolated problem than a sector-wide issue. The fact that all 6 major banks did not make any special mention regarding credit issues also supports this. I think the financial sector will be fine, but tech stocks still drive the market. Since they make up 30% of the S&P, it's crucial they keep rising. It's also good to see consumer cyclical stocks rebounding. Despite some polarization in the consumer sector, the overall trend remains healthy.
Over the past month, as the Magnificent Seven stocks entered a consolidation phase, the United States stock market has shown some signs of slowing down.
Even stocks like Amazon and Netflix are still well below their all-time highs. Therefore, it's important to accurately understand the fundamental reasons behind the market's movements. Nevertheless, I have a positive outlook on the future trend of the United States market. That's because Mag 7 has been rebounding again since last week. Apple and Tesla have shown breakout signals, and Nvidia rising above $195 is a very positive sign. Above all, the United States economy is in a much stronger condition than other regions around the world. The recent weakness of the dollar could have a positive effect on some emerging markets. However, overall, the United States is expected to maintain its competitive position over Europe and continue its advantage as we head into 2022.